Well, folks, we had the Fed rate decision yesterday. We got the 25 basis points that everybody was expecting. But did you know that the 10-year note went down yesterday? And if you haven't checked today, it is down again. So we're going to talk about rates, where they might be going. We're going to talk about spreads, and we're going to talk with the one and only Lance Lambert from Fortune. How you doing, sir?
Yeah, doing great. Really happy to be on here. A lot going on. So let's get into it.
Yeah. So one of the things that I put out yesterday, actually on Twitter, and said again this morning on the Daily Financial News is, okay, now we're at terminal rate. I've been thinking banks have been waiting to get here because we've had a very large spread, abnormally large spread between the 10-year note and mortgage rates. So now that we're there, now that Powell has put pause on the table clearly, my suspicion is the 10-year is going to come down. And then ultimately over the next 90 days, we're going to start to see banks compete and that spread is going to come down. So I think residential mortgages could be sub 6%, certainly by August, because that's just where it's going. I know you talked to lots of folks, including Mark Zandi. Just curious how all that feels and if I'm way off base.
Yeah, so here's where Mark is. And with the Moody's Analytics folks, they moved fairly quickly last year, early in the year, 2022, to have an outlook for the average 30-year fixed mortgage rate being 5.5. That was still when a lot were like, hey, are we going to stay closer to 4? They moved up then, and that's when their home price outlook nationally went to a 0% peak to trough, but then like markets like Boise and Austin being down 5 to 10. Through the year, as we got in closer to like August, September, they moved that from 6.5 to 5.5, not as much based on 10-year, but what was increasingly becoming a wider spread.
Oh, just so I'm clear, it moved from 5.5 to 6.5, not the other way.
Yes. So when
5.5
yes. And so and that outlook is less of like Mark Zandi being like, okay, we're going to be 6.5 for X number of months. That's more of like where we would kind of drift in this cycle during the peak, right? So so even when we went into 7, Mark was still like, I'm staying 6.5.
Good for
and the outlook for this year still was 6.5, generally speaking. And he had that drifting down, he said, to 5.5 by the end of 2024. So this has all been where Zandy's been for about 8, 9, 10 months, which is we drift at 6.5 for the top of the rate hiking cycle, and then over time drift back down to 5.5. And that's for the end of 2024. So that would still be, what is that, 18 months?
Yeah.
But what's interesting about Mark's outlook, and Goldman's right there with him, is that although they have mortgage rates coming down toward the end of 2024, they have the 10-year around 4.
Ooh,
and which is interesting. And some of that is based on the growth, 2% real growth in the economy and 2% inflation. That could get you to the 10-year being at 4.
Sure.
That's his outlook for the next 18 months, 6.5 this year, down to 5.5 by the end of 2024. Now, and the closing there would be the spread narrowing. That's how we get there, because the spread would have to narrow quite a bit if the 10-year would go up to 4. And that's a very different outlook than like Mortgage Bankers Association. And I think even kind of Fannie Mae, they've been thinking this year we kind of drift down. And then next year, there's just a little more of a drift down for both the 10-year and the 30-year fixed.
Yeah. And the reason why this is so important in it's just so important, because I think what we've learned, and you've shared the data, is 6% mortgage rate matters, at least on the demand side. Because we've seen it, I think twice in the last couple of months, it drifted, right? It hit 5.9 and then it hit like 6.1. We clearly have seen demand come off the sidelines sub 6. And that's why I think this is an important conversation. And if we're heading sub 6 by August, September, October, and listings are still down 20% year on year, and then it's a bifurcated market below and above the median, it's just going to be messy for first time home buyers.
Yeah. Well, yeah. I mean, it's, now if the spread is narrowing and that's how mortgage rates come down, right? That's only going to add fuel to the market, right?
Exactly. Of course.
Now, let's say the mortgage rates are coming down because the 10 years coming down because the economy is coming down very fast and labor, like, kind of breaks,
Yeah,
right? And if
sure.
there's a speed of the labor breaking, like not necessarily unemployment going up that high, but it's like enough to kind of scare people, kind of break that confidence.
Yep.
Because right now the market is like it's stabilized, and it's stabilized just a bit in favor of sellers.
Correct.
And the more you go down, like you said, to entry level, even more to sellers. But there's like, it's like the market isn't like there's not a ton of unlocked demand right now. There's actually still a lot
Correct.
of, but if you pull it down a little bit from confidence, you can kind of move that equilibrium.
Yep. I
So
agree.
if the mortgage rates are coming down because 10 years coming down and the economy's eating shit, maybe it's a
True.
different story. But generally, any drop in mortgage rates here is improving affordability. And the only real strain and negative on the market right now is affordability. It's not a bunch of supply.
Agreed.
It's not a
Agreed.
bunch of bad loans. It's just affordability. And last year, the market kind of got a little bit of a boil, right? It was simmering at 6% mortgage rates. And then when it got to 7, and the 7 happened in the weakest part of the year,
Yeah.
seasonally. And so we were kind of boiling and cooking there. But then affordability came down, the free fall in the market kind of hit the floor. You can't really go much below where activity's gotten to.
Yeah. Yeah.
And we've kind of stabilized here. So any drop in mortgage rates improves affordability. And depending on what the backdrop is, that could be, a market that starts to get fairly hot, maybe some warmth
Yeah.
to it.
It's just,
Or, if it's like things in the economy are going down, bad, then it's like, okay, maybe it's a little more of a mixed bag. Now, one thing that I think is interesting from Mark's view is that he thinks that the spread would have already started to kind of normalize more had the banking issues not started.
oh, interesting.
And
Okay.
so he sees the main buyers of these MBS securities being the Fed, which is backed out. They're not buying right now. And banks would have been naturally the ones to kind of grab more of it. But with their deposit issues, they're not stepping up. And there's also the theory of prepayment risk, which is that yes, these yields and these securities have good yields right now, but if you buy them and then everybody's refinancing because mortgage rates go down to 5 or 4.8, 5.5, that decreases the value of the yield, and so you need even a bigger yield now to make up for that potential loss in the future. So that too.
That's a great catch. Prepayment risk is a big deal, right? I mean, there are people out there betting that rates will go certainly sub 6. Some are saying even below 5.5, and that is real prepayment risk, right? You're at 7 on your first; it's now 5.5. It makes sense for many people to refi. So I think that's a good catch by him.
Well, another theory that I've gotten from another analyst is a little different, and this one gets more pushback, but the idea that lenders who have seen their volumes tank to make up for, and they're not going to be able to make up for it, but to at least to get some of the drop back, they charge more.
Yeah.
That's one theory. That one's gotten more pushback. But at the end of the day, the market has kind of stabilized at the yield the spread that we've seen around 300 basis points.
Right.
And we haven't seen it move too much. And ever since it kind of stabilized there, no matter what the Fed said, no matter what economic data has come in so far, we haven't been able to shake that. I think maybe this year we started to a little bit before the banking crisis. I'd have to pull the numbers again.
Yeah, it was a little bit.
When we got that 599 reading, do you know what the
that
10
was spread. That was a spread. I think the 10-year was, I want to say 3.8, 3.85, something like that. So it came in, but not a ton.
So that makes me kind of think maybe Mark's onto something a little bit.
So. I think he's right.
But not a lot. It's not like the spread. It's not like the deposit issues have seen the spread get greater.
Right. I think the issue is actually the banks didn't know where the terminal rate was, and so they just had to over. That's, and if I'm right, we'll know in 60 days because the terminal rate will pause, and we'll have all of that. So, but the whole point of this is rates matter. I think 6% really matters, and I think you posted it yesterday. We were at 6.39 or whatever it was. I think we're on our way to 6, and I think demand comes back. And
now one thing Mark did say is he does see risk in the short term to maybe do another push for 7 if the economic data broke hot, right?
We could know tomorrow, the jobs number tomorrow.
Now, that doesn't necessarily mean like the scenario where mortgage rates are down to 5.99 and the scenario where we go back to 7 in the next like 90, like say the next 120 days, right?
Okay.
Both two directions. It's not like the one is depending on how you get there, it's not like the one is so much more bullish than the other because it's like, okay, 7, like maybe we do another push at 7, but that's a scenario where these bank failures aren't really doing too much to the economy and it's just absorbing it. Things are hot. Inflation's still kind of there. And then the 5.99 is kind of like, okay, the markets are getting jitterier, or maybe we're kind of setting up to something a little darker. But if it's the same scenario, everything's equal, of course, any drop in mortgage rates is going to improve affordability and make things hot.
Well, folks, do me a favor. You've got to follow Lance Lambert at News Lambert on Twitter. He puts stuff out every day. Housing. He's a wonderful follower. And how can they find your Fortune articles?
Yeah, just Googling Lance Lambert Fortune, and it'll be the first thing that pops up.
That's awesome. Thanks, buddy.